You are third in line for your own money. Just let that sink in. You earned it. You sacrificed for it. You built something real, and the system designed to manage it serves itself first. Wall Street, Bank Street, Insurance Street are at the head of the table. Their broker representatives are next. Then, maybe, they get around to you. This isn't opinion. This is structure. Only 1 in 10 financial representatives you'll ever sit across from is legally required to put your interests first. 1 in 10. The other 9, they don't mind if you profit, but they'll make certain they do in ways that may never appear on your statement. I rejected that model before I began. Fee only, no commissions, no proprietary products, no conflicts buried in footnotes. Your interests aren't just considered, they're the only ones in the room. So, why does this matter? Because customers of financial institutions are being taken advantage of, and they don't even know it. According to a 2015 report from the White House Council of Economic Advisors, conflicted financial advice cost American investors approximately $17 billion per year in retirement savings alone. That's not a theoretical number. It plays out in living rooms and kitchen tables across the country, one transaction at a time. Let me tell you a story that illustrates exactly how. Several years ago, clients of mine, both physicians, had the cycle of life come their way. The husband's father, now 82 years old, moved into their cabin next door for socialization and family support. He was financially independent, mentally sharp, and had spent a lifetime making discerning choices with his money. As they helped him settle into this new chapter, I was asked to sit down and review his financial affairs. What I discovered was unsurprising to me. Nearly everyone I'd ever worked with has worked with another financial firm before me. I've witnessed the work of our industry firsthand, over and over again. Now, this gentleman had lived several states away and worked with a financial representative from a large, well-known brokerage house you would all recognize, someone he genuinely enjoyed working with. And over the years, he had built a portfolio of dividend-paying investments worth over $1 million. Between Social Security, a pension, and the dividends from his portfolio, he was set. He was living the life that he exactly wanted. He even recalled the roughly 20% stock market decline in the fourth quarter of 2018. He told me all his buddies were upset, but he wasn't. Why? Because he understood something most investors don't. While company share prices routinely go through declines, dividends are usually rising. And during that turbulent period, his dividend income had grown 8% year over year. His lifestyle wasn't threatened in the slightest. This was a man who understood his money. He then shared with me some transactions that brought a very different twist to this story. His broker had sold off his entire investment portfolio and used the proceeds to purchase a variable annuity. The rationale? The annuity would provide growth guarantees and income guarantees if he ever needed them. And at his age, the broker stressed, he needed to act soon, as he needed to protect his wealth and the wealth that his family would one day inherit. Now, why would he challenge that idea? This was his trusted advisor, a personal guy, someone he'd worked with for years. So he signed the documents. Now let's examine the results because here's what actually happened and what was never clearly disclosed. To purchase the annuity, the entire portfolio was liquidated, triggering capital gain taxes on decades of appreciation. Had he simply held that portfolio until it passed to his heirs, they would have received a step up in cost basis under current tax law, potentially eliminating that tax liability entirely. When the next statement arrived, everything appeared in order. No visible fees, no line item charges. But what he wasn't told was that the broker earned $80,000 in commissions on the sale of that annuity. His broker had previously been charging him 1.5% annually to manage his portfolio. Now, that's quite high for just managing an investment portfolio. There was no financial plan developed, no tax planning, no estate planning, and there was no performance benchmarking provided for him. I also discovered that his prior investment portfolio was held by his revocable trust, thus avoiding probate for the inheritors one day, and with the proceeds being made at the specific directions of the trust. His annuities beneficiary simply was named his estate to receive proceeds. This did not match up with the wishes of his trust. Inside the variable annuity, the combined investment management fees, mortality and expense charges, and the cost of the guarantees totaled 3.75% per year. Research from Morningstar has consistently shown that variable annuities carry some of the highest all-in costs of any retail investment product, often making it nearly impossible for the contract's actual returns to exceed the guaranteed minimum. He also had a 10-year lockup on the principal he invested. He would not have full access to his principal without paying a surrender fee for 10 years. Now, for an 82-year-old man, that means age 92 before his own money is truly liquid again. The urgency the broker created, it wasn't about protecting his clients. It was about the fact that the annuity couldn't be sold to someone over the age of 80. The deadline served the broker's income opportunity, not the client's financial well-being. So let me ask you plainly, was this massive change in investment strategy in the interest of the client or in the income interest of the broker? This is the embedded conflict of interest that exists when a financial representative's compensation is transactional. The incentive isn't to preserve what's working. The incentive is to generate activity because activity generates revenue. Now, here's what the public needs to understand. When people hear the words fee-based, they assume they're working with a fiduciary, someone legally bound to act in their best interest. They're not. Fee-based is a regulatory designation that allows an advisor to charge advisory fee and earn commissions on product sales. It's a dual registration model, and it's where these conflicts of interest live. What consumers should be looking for is a fee-only advisor. Fee-only means the advisor receives compensation solely from the client. No commissions, no revenue sharing, no hidden incentives. Now, does working with a fee-only advisor guarantee an exemplary outcome? No, but it does guarantee that the advisor's compensation structure is aligned with your interests, not competing against them. The financial services industry has spent decades blurring the line between salesperson and advisor. It's up to us, those who believe in doing right by clients, to make that line unmistakably clear. But here's what no one in this industry will say out loud. Even that isn't enough. I could put clients first financially and still watch them unravel. Perfect portfolios, fractured lives. Wealth evident, health gone. Relationships transactional. Purpose nowhere to be found. A 7 or 8 figure net worth means nothing when you're estranged from your children. A flawless allocation is irrelevant if you haven't slept well in 3 years. The money was protected, the person creating it, holding it, wasn't. So being a fiduciary became my floor, not my ceiling. That's why luminous wealth exists. Not to just eliminate conflicts of interest, that's table stakes, but to serve the whole person, to finally address what this industry refuses to touch: the gap between financial success and a life that actually feels successful. We move families from fragmentation to coherence, from wealth on paper to wealth you feel in your body, your home, your relationships, and your reason for being here. Wealth should illuminate every corner of your life, not just your balance sheet. If you've done well financially, but something essential still feels unaccounted for, we'd welcome that conversation. Connect with a member of our team at the link below.